Barton Biggs is the co-founder of Traxis Partners, joining us now from Greenwich, Connecticut. Barton, great to see you as always.
Good morning, Betty.
So Barton, last time we talked, you were about 90% long in the equity markets. Are you feeling a bit more nervous about that position after seeing what's happened in these last few days?
Yeah, I am, and I've cut it back a little, and I'm tempted to cut it back some more.
Okay, why is that? What's the thinking behind that, Barton?
Well, it seems that Europe is in a deepening recession, and the German numbers this morning were very disquieting. And at the same time, the heat is really on Spain, and both the stock market vigilantes and the fixed income vigilantes are now after Spain, and the stock market vigilantes are selling down the Spanish banks very dramatically. So we could be sort of drifting into another Euro country crisis. And at the same time, I don't think it's the greatest thing in the world that 3 Fed governors in the last 24 hours said that no more quantitative easing was needed, and I think the whole temper of what the Fed has been saying, that Bernanke seems to have backed off a little from his conviction for quantitative easing. So these are all in the short run here. These are negatives, and so I'd like to have a little less risk on than I had before.
But Barton, weren't you buying equities and increasing your long position, not so much based on that the Fed was going to come in with QE3, but you saw that the apocalypse seemed to have been avoided at that moment with Europe, and the economic data seems to have been improving here in the U.S. I mean, those things are still in place, though, Barton.
No, look, I agree with that, and it's clear that the world is still full of there's plenty of money out there. I mean, Magic Johnson and 3 other guys spent whatever it was, $1.3 billion to buy
over
a dysfunctional baseball franchise, and a lady from Gutter spends over $1 billion in the last year to buy art. I mean, and people are buying apartments in New York at fancy apartments at a big rate. So there's still plenty of money out there. I'm just talking about a short-term situation here. But we've had a big move, and so could we have a little bit of a pullback? Yeah, I think we could, 5 to 7%, something like that.
Barton, you were just saying that, look, you may be looking at paring back some of your net long positions in equity. As you're paring that back, where are you going to put your money?
Well, I'm going to put my money. I'm going to leave my money, and I'm going to sell the S&P short some way like that to hedge the positions I already have. I don't necessarily want to disturb them, but I just want to take. I may want to take a little risk off. I want to see what this jobs number that's coming out today looks like, and I want to see what happened in Europe this morning was sort of mixed. I mean, the French auction went pretty well, but Spain is clearly still under attack by the speculators. But on the other hand, I mean, as I say, I'm looking for a 5 to 7% correction. It seems the most likely possibility, but there are still a lot of good signs out there. I mean, hedge funds on the ISI survey were pretty significant reducers of their net long last week. The U.S. public put $20 billion into bond funds in February and $30 billion in March, and there was $2.2 billion of net redemptions of U.S. equity funds by the public last week. And those are, I think those are all reasonably encouraging signs. And so, I think we're going higher over the course of the next few months. But in the short run here, we'll have a little pause.
Barton, you mentioned the jobs report. I mean, we're going to have jobless claims later today, and we'll have obviously the monthly jobs report tomorrow. If they came in better than expected, to continue to show pretty robust jobs growth, would that change any of your positions in your portfolio, or what you would do with your portfolio?
No, I don't think so. I mean, the jobs report is what it is, and in a way, a strong jobs report would almost be perhaps even a little negative, because it would confirm the opinion of those 3 Fed governors that basically are lecturing the chairman that there shouldn't be any more quantitative easing or dramatic liquidity injections. And I think the markets want to see more liquidity. The markets are still worried. The markets read Reinhardt and Rogoff and which suggests that after every financial crisis, there's a long period of much slower growth, and in almost every case, you get a double dip. And I think Bernanke has read his Reinhardt and Rogoff, and he went to school, went to MIT with those guys, and so he's well aware of the risks.
So does that mean then, Barton, if I can make sure I have this clear, that without extra liquidity, without QE3, this market may have some struggles in trying to gain much more?
Yeah, I think so. I think so. And I mean, look, if we begin to get some really spectacular jobs numbers and indications that the economy was really into a positive feedback loop and a self-sustaining recovery, that would change the picture for the whole world. That would make things a lot better in Europe too, incidentally. And one of the reasons Europe is as soggy as it is, because Europe needs the U.S. So yeah, I think that really dramatic numbers could change things.
Well, I imagine, right, dramatic economic numbers would certainly change the whole picture, change the whole game here in the markets. Barton, quickly, because we have talked about Apple over and over again, and your holding in that stock, and just in the last few days, really, we've had analysts come out and say Apple can rise to $1,000 a share, and some might see that as a warning sign that maybe we're getting into bubble territory, irrational exuberance around a stock like that. What's your take?
Yeah, I think we probably are. I mean, look, the history of consumer technology products is littered with great successes that last 2 or 3 years and then burn out. I mean, you're too young, but I remember the Walkman. The Walkman was going to transform our lives. Well, but it only did for a relatively short period of time, and then it was history. And look at poor old RIM. I mean, so.
Barton, so are you tempted to sell? But then are you tempted to sell your Apple holdings then? You've done so well with them?
Yeah, I'm definitely tempted to again, but these are, you can't be, you're not going to get perfect timing. So I'm inclined on something like Apple to be scaling out as it goes up, and just as I'm inclined to be selling short gradually the 10-year U.S. Treasury bond, but we've all learned that our timing is not perfect.
That's right. Hard to market time these days. Barton, great to see you again. Barton Biggs of Traxis Partners.